Stock too pricey? Warren Buffett's Berkshire Hathaway is trouncing the stock market this year, which makes the company's annual meeting in Omaha on May 3 a celebration of 60 years of good fortune, but also a moment to reflect on what is still to come. Buffett's star has never burned brighter. Few companies have created more wealth for individual investors than Berkshire, with many long-term holders sitting on stock worth $100 million or more. The Class A shares, now around $795,000 and near a record, are up 40,000-fold from around $20 in 1965, when Buffett took control of a struggling textile company and began his run as Berkshire's leader. Berkshire has stood out in a year when many are moaning about losses in their equity portfolios. The stock is up 17%, besting the S&P 500 by 23 points, the widest margin since 2007. Buffett's decision to build a war chest of more than $300 billion in cash and equivalents, the most of any U.S. company, by selling a net $134 billion of stocks last year, mostly Apple shares, now looks prescient. Yet investors may be feeling some unease given Buffett's age. He turns 95 in August. Buffett told shareholders in his annual letter in February that it won't be long before his likely successor, Berkshire executive Greg Abel, replaces him as CEO. Few companies are more closely associated with their chief executive than Buffett, and that's a risk for investors. He's the most iconic CEO in the history of CEOs, says KBW analyst Meyer Shields. A lot of investors own the stock because of Warren Buffett. Still, now seems like an inopportune moment to chase Berkshire stock. It looks richly valued relative to its history and shows little sign that investors are worried the company will lose some of its magic without Buffett at the helm. The Class A shares trade for 1.7 times book value, their highest ratio since 2007, and for 25 times projected 2025 earnings, a larger than usual premium to the S&P 500, which fetches about 20 times. What's more, analysts see little earnings growth this year or next. The stock also trades at or above what some analysts and investors estimate to be the company's intrinsic value, essentially a sum of the parts valuation favored by Buffett, versus a meaningful discount in recent years. Berkshire now fetches a slight premium to the estimate of intrinsic value published by investor Semper Augustus Investments' Chris Bloomstrand, who owns the stock, against a 25% discount in early 2024, and a 10% premium to UBS analyst Brian Meredith's estimate. Buffett, too, may view the stock as overpriced. Berkshire hasn't repurchased shares from May 2024 through early March, the latest date for which there is disclosure. That compares with buybacks of over $24 billion annually in 2020 and 2021, when the stock traded for as little as book value. Berkshire's extended valuation could mean that, in the next few years, the stock will underperform the S&P 500, the benchmark to which Buffett regularly compares Berkshire stock. Though the stock doesn't look cheap, the giant conglomerate has never been in better financial shape. Not only was Berkshire sitting on $318 billion in cash at the end of 2024, but its operating earnings excluding investment gains are running at more than $45 billion annually after taxes. Berkshire's market value of $1.2 trillion, behind only Apple, Microsoft, Nvidia, Alphabet, Amazon.com, and Meta Platforms, suggests it, not Tesla, should be part of the Magnificent Seven. At the annual meeting, Buffett will share the stage with Abel and insurance chief Ajit Jain, answering shareholder questions for 4.5 hours on a range of topics. Investors will get less time with him than in the past. Buffett has cut back the length of the Q&A segment by about an hour relative to last year, perhaps in a concession to age, and will end shareholder questions at 1 p.m. local time rather than later in the afternoon. Even so, investors will be watching him closely. He has sharply reduced his public appearances in recent years, and the annual meeting is the only time that investors get to hear from him at any length and see how he is faring with their own eyes. Catherine Seifert, an analyst at CFRA, says investors will be interested in Buffett's view on Berkshire, tariffs, and the economy as well as qualitative elements. How is he doing and what is his demeanor? The questions are apt to come fast and furious, starting with the direction of the company after Buffett steps aside. Abel, who headed Berkshire's utility business before taking on his current role in 2018, has been running Berkshire's non-insurance business on a day-to-day basis. He has earned praise from Buffett, who says Abel takes a more hands-on approach and is getting better results from the company's 100-plus subsidiaries. Buffett was a hands-off manager famous for simple, one-page employment contracts with Berkshire's operating chiefs. While Abel is likely to be CEO, Buffett's children, Howard, Susan, and Peter, could play outsized roles in the future of the company. They will control the trust holding Warren Buffett's stock after his death and wield considerable power. Howard, now a board member, is likely to become chairman, and Susan, now on the board, probably will remain a director. Buffett's stake is now 14% of the company on an economic basis, but he has 30% of the voting rights due to his ownership of the supervoting Class A stock. That stake is falling slightly each year as Buffett gives away shares. The family's influence will diminish over time after Buffett's death, as stock is donated to various philanthropies over more than a decade based on Buffett's stated wishes. But his children will exercise considerable influence during the initial years after Buffett's death. One thing the children are likely to resist is a breakup of the company, something Buffett opposes and fears might happen after his death. Buffett believes there are benefits to the conglomerate structure. There also could be management changes after Buffett leaves the scene. Jane, now 73, could depart, and possibly be replaced by Joe Brandon, a Berkshire insurance executive who was head of Allegheny before Berkshire bought the company in 2022. Investment managers Todd Combs and Ted Weschler, who now run about 10% of Berkshire's $300 billion equity portfolio, could take over the whole thing. It remains to be seen which role Abel will play with the equity portfolio. Investors might also be curious about whether Berkshire will pay a dividend after Buffett departs. Buffett has long opposed one, arguing that the company's earnings and cash are better in his hands. That has been fine with the Berkshire faithful, but the policy will probably change once Buffett departs. Large, highly profitable companies, including former holdouts Alphabet and Meta Platforms, invariably pay dividends, and it will be harder for Abel to resist. It would be a great way to show leadership without changing the culture, says KBW Shields. A dividend would also take some pressure off Abel to invest Berkshire's ample earnings. Other shareholders will have more immediate concerns, such as whether Berkshire has taken advantage of recent stock market turmoil to invest a chunk of the $300 billion plus in cash, more than the value of the stocks in its portfolio. Many would like to see a repeat of the 2022 meeting, when Buffett revealed about $50 billion of buys early that year, including Occidental Petroleum and Chevron. Shields thinks investors looking for big Berkshire buys may be disappointed. Aside from a brief period in 2022, Buffett has been cautious on new investments over the past 5 years, and Berkshire has been a net seller of stocks in 4 of the past 5 years. The large cash buffer serves another purpose. It would give Abel the ability to buy back a lot of stock if the shares tumble on Buffett's exit. Buffett may be building so much cash in anticipation of the management transition, Shields says. Investors hoping that Buffett lands what he called an elephant-size acquisition in the coming years may also be disappointed. Berkshire hasn't made a major deal since 2016, when it overpaid to purchase aircraft parts maker Precision Castparts for about $34 billion. That acquisition has been a big disappointment. The company was hit hard during COVID, and its revenue is barely back to where it stood a decade ago. Precision might now be worth what Berkshire paid for it, while the S&P 500 has tripled over the same period. Time is running out for stocks. Trump's next move is crucial. The waiting is the hardest part. Whether it's waiting for a delayed flight, to find out if we got that new job, or to see if we won the lottery, long periods of uncertainty are difficult to endure. There's a desire to do something, have a stiff drink, send one too many follow-ups, or spend money we don't have, to make time go faster and to tamp down the anxiety that comes when faced with the unknown. The stock market finds itself in that position now, waiting to see whether President Donald Trump's tariff policy will cause a recession or whether the U.S. can still emerge relatively unscathed. Thankfully, the near certainty of doom that seemed apparent just a couple of weeks ago has faded after Trump blinked on tariffs. After gaining 4.6% this past week, the S&P 500 index has now climbed 11% from its April 8 closing low, and the temptation is to consider the worst over. Resist that temptation. Sure, it's easy to imagine a bull case, even a long-term one. The president, who this past week said tariffs on China will come down substantially, has bought himself time to work out one-on-one deals with countries around the globe, and just one deal, any deal, could cause markets to jump. His deal-making could also push other countries to strike deals with one another. The result could be a world that hasn't deglobalized but just reordered itself, as Jawad Mian writes in his Stray Reflections newsletter. Adding to the case for upside, tech stocks finally showed signs of life this past week. ServiceNow jumped 21%, Texas Instruments gained more than 9%, and even Alphabet rose 7.7%, helped by its own results. Good news given the underperformance of the Magnificent Seven since the DeepSeek sell-off began near the end of January. Yet the bear case seems just as reasonable. While Trump has dialed back the tariff rhetoric, the next Truth Social post could send stocks lower. And investors are still waiting to see what damage has already been done by the will he or won't he nature of trade policy. The hard data have held up well because the penalties haven't started yet, and that will probably be true for first quarter gross domestic product, to be released on April 30th, and April's payrolls report on May 2nd. That has investors eyeing May's or June's results for the first sense of the damage done. It could go either way. Polymarket puts the chances of a U.S. recession at 55%, and that seems about right, which means picking a direction, either direction, is probably no better than a coin flip. In the very short term, the equity pain trade likely remains to the upside as the market prepositions on tariff de-escalation, writes J.P. Morgan strategist Dubravko Lakos-Bujas. However, as the summer approaches, we could start to see some softness in activity due to aggressive tariff-related front-loading, lagged effects of other policies, and lower business investment activity. In other words, tariffs still loom. While the 145% penalty on Chinese goods is unlikely to hold, Trump himself has floated a rate that could be 50% to 65%, as Evercore ISI strategist Julian Emanuel notes. Combined with 10% levies on the rest of the world, that would average out to about 17.5% at its midpoint by year-end. That would put the S&P 500 at 5,600, or up 1.3% from Friday's close of 5,525.21. But Emanuel expects the market to remain range-bound for a while. The decline in trade policy uncertainty from parabolic to merely extraordinarily elevated is priced in, he writes, which sets up the S&P 500 to trade in a range of 5,100 to 5,600 unless concrete policy news emerges. A retest could come soon. 22V Research's Dennis Debuschier predicts that the market wants to see an aggressive reduction in Chinese tariffs, or it is likely to test the Trump administration again. The good news is that the economy was solid before the trade war started, and first-quarter corporate earnings have held up well. If tariffs come down quickly, the U.S. economy should be able to avoid the worst. But if not? A reduction in China tariffs is needed quickly, Debuschier writes. Otherwise, tariffs will come down the hard way after a recession starts. Maybe the wait won't be so long after all. For investors, food stocks have been as appetizing as a plate full of slugs. And no, it isn't about RFK Jr. On Wednesday. Health and Human Services Secretary Robert F. Kennedy Jr. announced the phase-out of 8 dyes commonly used in U.S. foods, something that companies should have, and probably did, see coming. Yes, we love the rainbow of colors in a bag of Skittles or the blinding brightness of our Trix cereal, but when even my 14-year-old son checks ingredients and avoids artificial colors and flavors, you know it's time to move on. The companies, which haven't pushed back against the rule, probably know it. But their troubles go well beyond their use of dyes. There's more from Kennedy. He also wants to make soft drinks and snacks ineligible for the Supplemental Nutrition Assistance Program, while Ozempic and other weight loss drugs have hit snacking too. So has the proliferation of fitness trackers and calorie counting and ingredient checking apps. Big food companies also raised prices more than they needed to during the pandemic, and consumers are looking for cheaper and healthier alternatives, says TD Cowen analyst Robert Moskow. Some of these headwinds are reflected in food stocks, which dropped 8.7% over the past 12 months while the S&P 500 rose 11%. And while food stocks have outperformed so far this year, the S&P 500 Food Products Index has returned 0.1% to the S&P 500's 5.7% loss. They have underperformed the consumer staples sector's 5.1% rise. Many prominent companies, including PepsiCo, Conagra Brands, Campbell's, and General Mills, have suffered nearly as much as or even more than the market. Worse still, they probably won't recover their previous haven status without major changes, Moskow writes. What should food companies do? Boost the perception of quality, upgrade the product, or cut the price, according to Moskow. Campbell's should improve the quality of its soups, prepare for price cuts, and consider unloading its V8 brand, while General Mills should cut prices and focus on product quality in its advertising. Kraft Heinz needs to invest in higher quality, especially in products like Lunchables, Capri Sun, and Mac Cheese, where the company has lost share as customers pivoted to healthier options, he writes. Taking such steps will be far from painless. But making changes at the margins doesn't seem to be helping either. PepsiCo stock fell to its lowest level in 4 years this past Thursday after the company missed earnings forecasts and lowered its full-year guidance. Comments about phasing out dyes and offering more price points didn't seem to appease investors. Making big changes doesn't have to lead to disaster. RBC analyst Nick Modi points to Constellation Brands, which cut its medium-term outlook earlier in April on concerns about tariffs and industry pressures. The stock rose 0.7% even as the S&P 500 fell 3.5%. We believe investors are of the view that the company took down its numbers enough as to provide a buffer even if things deteriorate further, writes Modi, who counts the stock as one of his top picks. Just don't expect the safety that food stocks once offered. If most gaming companies are playing checkers, Duolingo is playing chess, literally. The company, known for its language games that teach users Spanish, French, German, Japanese, Korean, and Chinese, among others, announced this past week that it had launched a new offering in beta form, chess. It's the app's first new addition since it added math and music in 2023. While some might see chess as an egghead pursuit, it has an enormous following. While data are hard to come by, D.A. Davidson analyst Wyatt Swanson estimates that some 690 million people play the game, while the website chess.com has 210 million registered users. What separates Duolingo's offering from others is its focus on teaching people how to play the game, not just offering them a place to compete. If all goes well, chess could bring in $60 million to $150 million in total bookings in 2026. Swanson rates the stock a buy with a $410 price target, up 7.4% from Friday's close of $381.83. Duolingo doesn't need chess to succeed, however. When Morgan Stanley analyst Nathan Feather initiated coverage of the stock with an overweight rating on Wednesday, he played down the company's offerings outside its core language games. Language learning is 4 times as large as music, the follow-up category, and Feather refers to the non-core offerings as call options, bets that could pay off but where success isn't the base case. That didn't stop him from initiating the stock with a street-high $435 price target, and the possibility of $530 if everything goes right. The list of reasons for optimism is long. They include a large total addressable market, one big enough to boost revenue by 26% annually over the next 5 years, margins that could increase to 40% by 2029, with an outside chance of reaching 50%. And the fact that it's a beneficiary of artificial intelligence with its generative AI-based Max tier. With the stock about 30% off the high despite no tariff risk or history of macro sensitivity, we see this as a compelling entry point, he writes. Perhaps a little less compelling now. Duolingo stock jumped 10% on Wednesday, and the stock finished the week down just 13% from its February high, though it still has